first, let me say thank you for having me here this morning. I really like these macro modeling workshops. I think the tradition of having them in person and these online meetings since COVID and the sort of new model with a range of meetings over the course of the year, I think it's a really great thing where a broad set of people are able to sort of show their research and get feedback, and also, a set of people getting access to sort of research that's relevant for central banks. So I really like the format, and I'm happy to be here today. The paper's been evolving over time. It's about recession signals and business cycle dynamics, trying to think about integrating them. Before I begin, I should say, as emphasized here on the title slide, I have this sort of standard disclaimer, but it really does apply in this context and in all of my work, that any views I express today are my own and do not reflect those of the Federal Reserve or its staff. Right? We really do have a tradition of independent research. It's valuable, and I certainly try to take advantage of that by feeling free to explore topics and do the best job I can to illustrate the issues. So I'm going to talk today. I know that in this online format, we have time for questions at the end, and I will sort of presume that nothing I say is so confusing over the course of this morning, this afternoon, or this evening, depending on where you are, that people need to jump in. Of course, if someone jumps in, I don't mind any sort of clarifying questions in real time, but we should have plenty of time at the end, even though I know based on the end of the last session that people may need a break after this. I think we will have time. But if you do have a question, please feel free to hop in. So what's the motivation? What am I looking at today? I mean, in this audience, or even on this topic, I don't think there's much need to motivate why one should look at predictors of recession. But the basic idea, right, is that many people, research economists, certainly policymakers, financial market professionals, and the general public are very interested in signals regarding whether a recession may be approaching. So here's just one example of recent interest in this topic. This is in the United States, searches for recession on Google, as measured in Google Trends. And as one can see, in 2022, in the middle of last year, interest in recessions, reached an quote unquote all-time high in terms of Google Trend searches. Now, obviously, there may be underlying trends or something, but I think it's clear from this graph that in general, people become interested in recessions when there are fears that the economy is weakening or may weaken. And those were appreciable in around the global financial crisis, around 2019, actually in advance of COVID, certainly during COVID, and then very much so in 2022. And we all know there are good reasons for that. Recessions cause a great deal of economic harm. They lead to substantial increases in unemployment. So that pain is disproportionately felt by those who lose their jobs. Obviously, there are broader economic consequences, declines in incomes for broad swaths of the population, shifts in asset prices that make whether or not a recession is coming of interest to financial market professionals and others. Now, I should say, as a macroeconomic modeler, at least historically, right, that, in many of our theoretical models, a recession is not necessarily especially different, right? It's a manifestation of adverse shocks interacting with the structure of the economy. There may be sort of underlying non-linearities that make recessions sort of deeper or have more adverse welfare consequences than the flip side, expansions, right? But I am going to be taking a sort of very reduced form approach, thinking about discrete events of recessions, but certainly in the back of my mind, I have the idea that actually in models of business cycles, recessions are not necessarily discrete events. They may be nonlinear events. but they really are manifestations, through the same propagation mechanisms of adverse shocks, as expansions are. Indeed, a small part of what I wanted to do today is use that general thought that the business cycle is a cycle with ups and downs to think about how to categorize possible signals of recession. So that's the extent to which my empirical analysis will sort of be tied to the business cycle literature. So my contribution is to go back to the research literature, think about what has been identified as recession signals, and I'm going to broadly categorize them into three categories: financial indicators, leading indicators of the business cycle, or time series that capture momentum and whether or not an expansion is likely to continue or a recession is likely to begin, and signals of the state of the business cycle. So where are we in the business cycle, and what might that imply for whether a recession is likely? I think it's fair to say, if one goes back through the research literature, and I'll do a bit of that in my discussion this morning, that there is a very large literature on using financial indicators to forecast recessions. There is quite a substantial literature on using leading indicators. And then there's I would say, a smaller literature focused on the state of the business cycle, although part of that is definitional. A fair amount of the leading indicator work one could view as being a part of thinking about the state of the business cycle. But one thing that I'll emphasize today is the difference in time horizon and how different sort of state variables versus momentum variables, may be useful for thinking about recession dynamics in the very near term over a medium term versus a medium term horizon. So I'm going to examine this set of indicators primarily from an empirical literature and think about the recession prediction literature. But I also want to tie it into just a view of business cycle literatures as an organizing principle for thinking about, well, what should we expect from these various indicators in terms of their utility for forecasting recessions at different horizons. So as I noted, the previous literature has explored these issues fairly extensively. And a lot of that literature has focused on financial indicators. I think we all know, certainly in the United States, but really it is an international phenomenon, that using the slope of the yield curve to predict recessions is an industry in and of itself. It's very common in academic research. It's very common at central banks. And it's very common in the popular press to see discussions of whether or not, for example, an inverted yield curve is an indicator that a recession may begin soon. So for example, there's a running bibliography on the website of the Federal Reserve Bank of New York. And as of the middle of 2022, I'm sure this has actually changed, but as of the middle of 2022, that running bibliography listed 114 articles in economic journals on using the yield curve to forecast recessions, right? So that is a very well explored area of empirics. And I'm going to look at that indicator because it's really important based on all that other research. But I don't think anything I'm going to say regarding that indicator is particularly new, right? There are 114 other studies, all by really good economists. And what I'm going to do is take that as sort of given and use that to think about what are the role of other indicators and what does that tell us about, different horizons, what are the factors behind why the yield curve versus other indicators may be useful at different horizons. Of course, other financial indicators are also useful, and lots of financial variables are highly correlated. I'm not going to try to be comprehensive today. What I've tried to do is to go back to the literature, and it really does seem to be the case that the most prominent predictor of recessions sort of globally that's been explored in literature is the yield curve. That's certainly true for the United States. I think a secondary set of indicators that is very important in recent literature on business cycle prediction are looking at sort of measures of corporate bond spreads, whether those be simple measures of spreads or more complex ones that try to extract sort of risk premia from default probabilities such as the excess bond premium of Gilchrist and Zakrajek. There certainly is a literature emphasizing that that's a good predictor. And in order to be somewhat complete, I'm also going to both reference that and use it. But more broadly, I'm not going to, as we'll see, I want to think about a sort of comprehensive, but sufficiently small in order to understand the results set of indicators. So I'll primarily look at those two indicators, even though a lot of other research, has considered other indicators like equity prices or, a broad range of financial indicators. Indeed, my own research, I have a paper from a few years ago arguing that equity prices are a much better predictor than people sort of seem to think they are. Nonetheless, despite my previous research, I'm going to try to limit myself and focus primarily on measures of the yield curve and the corporate bond spread as financial indicators, because that really is, I think, the dominant strain of the existing literature, and I want to connect to that existing literature. A second strand of literature to which I hope to connect is that on leading indicators. And obviously, this is a very long and well-established research program. We all know the work of Burns and Mitchell on sort of understanding the business cycle and developing both coincident and leading indicators. And that really is quite a long time ago. As you all know, right, Burns and Mitchell were actually thinking about coincident and leading indicators at a time when actually other indicators didn't exist, right? So their work on coincident indicators was contemporaneous and even predated national income accounting, right? So one of the reasons they were so focused on coincident economic indicators is they didn't have GDP to look at, and they were trying to understand the business cycle by thinking of indicators other than GDP, right? And so that's really how old this literature is, right? It even predates the work of Kuznets and Mead and many others on national income accounting. But obviously a lot of that work still continues, and there are sort of standard measures of leading indicators that are published every month by sort of non-official groups such as the Conference Board, and the OECD publishes a list of leading indicators for all of its member countries every month, right? Because it's something that people are very interested in. And I'm going to consider that in part in order to understand, well, how is that different from other measures of the business cycle? And in particular, recently, research has emphasized, and it's quite intuitive, and I mean, recently, just in this sort of recession prediction literature, I think more generally, this is a very old idea, that variables like inflation and the level of the unemployment rate are important precursors or indicators of whether or not a recession is likely in the United States. It's not actually that common in the sort of recession prediction literature, but it's quite intuitive, and it's certainly common in the macroeconomic discussion, right? So prior to the early 1990s, I think there was a large literature, one sort of capstone in the late 1980s was work by Romer and Romer. And basically that literature, right, it was, well, recessions don't just happen, right? Expansions are killed by the Federal Reserve, right? And they're killed by the Federal Reserve because inflation was too high. And that really when inflation gets too high, monetary policy needs to be tight, and that causes a recession. It's arguably less true for the recessions of in the U.S. of 2000, 2008, and 2020. But nonetheless, looking back over the broad history, the notion that inflation is an important precursor to a recession, sort of well established heuristically, even if not in the recession prediction literature. And then some other research, including my work at unemployment risk, and others have emphasized, well, look, actually, when the unemployment rate gets, near 4, it's pretty much guaranteed to go up over the next couple of years, because that has just always happened. It just doesn't get any lower. And so low unemployment is a good predictor of large increases in recessions, and that's something that I explored in my JMCB paper and some other papers, and that Larry Summers and Alex Domash have also talked about. Okay, So that's sort of the previous work, and those are the sort of three categories of variables that I am going to consider. But let's just think about a sort of organizing way about like what might those different indicators imply for predicting a recession. Okay, so 75–80% of my work is empirical here, but I just want to do some illustrative pictures of what the dynamics of a business cycle look like, and what that might say about how to use financial conditions, how to use momentum or leading indicators, and how to use the state of the business cycle to think about whether or not a recession is coming. So it's going to be a very simple quote unquote model. And it's just going to be a traditional hump-shaped view of the business cycle in which the unemployment rate follows a AR2 process. Right? So this is a linear process. I'm not going to emphasize the sort of non-linearities that characterize recessions that I mentioned in the introduction. And then there are various shocks that drive those hump-shaped dynamics. I'm just going to focus on one, and that's financial conditions, whether financial conditions are expansionary or contractionary. Those might be gauged by things like the yield curve or corporate bond spreads. Of course, this is really just a description of any shock. Right? So in this equation, right, the unemployment rate is an AR2. What's going to happen when you get a shock in a typical AR2 for the unemployment rate in the United States is that an adverse, or let's say a positive shock. A positive shock leads to a decline in the unemployment rate. That then gathers a bit of business cycle momentum through sort of multiplier accelerator dynamics. The unemployment rate initially falls further following the shock. And then after about a year or so, that positive impetus begins to fade. The unemployment rate is no longer falling, but rather reaches a trough. And after that trough, there's a return to normal where the unemployment rate rises, right? And so if the impetus to financial conditions is a positive one in this equation, right? So that is a sort of expansionary state of financial conditions. There's a negative sign in this AR2, so unemployment first falls. It falls for a while, and then the sort of lag dynamics kick in and unemployment starts to rise. And obviously, this is just a linear equation, so the opposite occurs with a negative or recessionary impulse to financial conditions. So what does that imply? Well, here there's just a picture of what I just described, where I consider positive and negative impulses from financial conditions. Right, so a positive impulse are the red line here. That's an impulse that lowers the unemployment rate. So this is an expansion. And a negative impulse is the blue line, right? That's a recessionary impulse that initially raises the unemployment rate. So what does this picture tell us about when a recession happens and what happens before a recession? Well, right, let's just focus on the blue line where there is a negative recessionary impulse. What one sees is that the unemployment rate jumps following the negative impulse, and then it rises further, right? So if one has an indicator of financial conditions and that turns contractionary, right, that both initially starts the recession, but provides a signal that things are going to get worse. So there is a degree of leading information in the near term in financial conditions. So according to that sort of blue line, that recessionary dynamic, financial conditions should be, useful for predicting recessions in the near and medium term as a recession dynamic kicks off and then gains momentum via multiplier accelerator dynamics, where the unemployment rate rises for a year or more. So that would suggest that, in this simple framework, if financial conditions are a key impulse, that at a horizon of about 1 year, financial conditions would be a useful predictor. Similarly, under this dynamic that I just described, there's an initial adverse impulse, but the economy then has momentum. And that momentum is in a recessionary direction. So near-term indicators of momentum is the economy getting worse, right? That kicks off right here in period 0 with the adverse shock. And that is followed by a further worsening in conditions. So indicators of momentum, which really are, as I'll discuss when we get to the data portion, the traditional set of leading indicators, should provide a signal in the very near term, right? So at this sort of 1 to 3, 4-quarter horizon of a recessionary dynamic, because that momentum builds. Okay? So that would suggest that financial conditions are useful at sort of a 1-ish year horizon, and momentum at a 1-year or shorter horizon. So what about the flip side of what happens when there is a very strong economy, a positive set of influences? When one has a positive set of influences, the unemployment rate initially falls. And what one sees is that the unemployment rate, just in the inverse, is falling for several quarters. But after that, and this is just that what goes up must come down. This is just that there is mean reversion in the business cycle. It's a cycle. There's a cyclical temporary component. That the unemployment rate, after it goes down, is going to go back up. And at least in the United States, right, a recession is when the unemployment rate goes up. So according to this red line, what happens is that if the economy is very strong, well, after a year or two, following this traditional hump-shaped dynamic, the economy is going to be weaker. That's simply the cycle in the business cycle. And so over medium-term horizons, one would expect the state of the business cycle, right, if the unemployment rate has gotten very low, that you expect it to go back up. And this is not complicated. This is just that the business cycle is a cycle. This is just mean reversion. Right? But it's an important thing to remember, right? Because mean reversion, if there is a cycle, is something one needs to control for and think about empirically in thinking about whether or not a recession is likely. Okay. So I'm just going to use that sort of basic intuition to then go to the data. So I'm going to look at 3 groups of recession signals: financial conditions, momentum, and or leading indicators, and the state of the business cycle. With that sort of organizing framework in mind, I'm going to use, and this is the sort of maximum available for prediction horizons of 1 to 2 years, data from 1965 to 2019 Q4. So that's going to be the end point, is going to be whether or not a recession occurred by 2019 Q4. So for example, even when I'm predicting a recession 2 years ahead, like the last predictor point would be 2017, and the last prediction would be for the end of 2019. I'm not going to try to predict the COVID recession. Actually, all of the results are essentially identical, even if one includes the COVID recession, right? Because actually all the things that are predicted to be good recession predictors were actually true in 2019, and then a recession did happen. I ignore that because that sounds like luck to me. I don't believe that the yield curve predicted COVID, and I don't believe that low unemployment predicted COVID. But I should be clear, the results do not depend on not including data through 2022. The results would be exactly the same. But I'm going to just focus on data from 1965 to 2019. I'm going to actually consider 3 definitions of recessions in the United States. I'm going to consider the definition of the NBER, right, which is subjective and looks at many indicators. But I'm also going to consider sort of 2 just more algorithmic and simple definitions. One is going to be if the unemployment rate rises by 3/4 of a percentage point, or if the unemployment rises by an amount greater than its unconditional 80th percentile over the sample period, right? So that's a 1 in 5 event. Recessions in the United States happen about 1 every 6 years, or about a 15% unconditional probability of a recession. And so this is just a 20% event for the unemployment rate. That's what I used in my paper on unemployment risk, and it's very similar. I mean, it's almost identical to the NBER definition, but it doesn't rely on the NBER. And then similarly, I'm just going to use the adverse 20% outcome for GDP growth, which is essentially that GDP per capita declines So again, it's the sort of traditional view of what a recession is, the GDP declines. But it's not relying on the MBR. It's just using a threshold that the growth rate of GDP over a certain horizon is below its 20th percentile. So I'm going to predicting something that happens sort of 1 every 6 years in my sample period when I use MBR recessions, or roughly speaking, 1 every 5 years when I use the 20th percentile for GDP growth, or the 80th percentile, right, which is just the opposite sign, right? It's a decrease in GDP or an increase in unemployment for the unemployment percentile. So I'm going to look at those 3 definitions. They're not identical, but they're very, very close. So I'm close to predicting the same thing, but the time periods are a little bit different. And I do that in order to connect to other work on sort of quantile regressions in business cycles, and just to see how robust results are. And there are slight differences. They're sort of interesting, but I'm not going to emphasize them. The results are broadly speaking very similar. And then I'm going to look at a set of predictors where I try to be comprehensive, but also have a small number of permutations so that we can understand the results. So for financial conditions, building off the previous literature, I'm going to use the term spread. I'm going to use the 10-year treasury yield minus the federal funds rate. I could use, there's lots of measures. People argue over what is the right measure of the term spread. A lot of research uses something like the 10-year minus the Fed funds rate, or the 10-year minus the 3-month treasury yield. Others use the 10-year minus the 2-year. Others use the 2-year minus the funds rate. I'm just going to pick one. I think the results are pretty representative of the literature. I'm going to use the BEA corporate bond spread because it gives me a long history of a corporate bond spread, longer than the excess bond premium. And it's sort of widely used, easy for people to reproduce. I think the results are, again, broadly in line with the literature, and that's what I'm aiming for. For indicators of momentum, I'm going to use the OECD's leading economic indicator. As many of you know, that is an indicator that combines measures of sort of strength in the labor market, such as unemployment claims, measures of consumer and business confidence from surveys, measures of sort of housing starts or other leading indicators. So I would mention 2 things, right? There's obvious data snooping bias. The OECD conducts this leading indicator in order to predict recessions. It had better be a good indicator of recession, right? Because actually it's constructed in order to do so. So I am not trying to suggest that this is sort of new ground. Rather, what I am trying to do is control for things that others have explored in the literature and think about the relative usefulness of an indicator like that at different time horizons. And I'll get to that for a minute, because the different time horizons is really important for my discussion. And to think about the usefulness of that indicator, those sets of indicators, which are very common in the literature, relative to the other indicators, including financial conditions, but importantly, including my 3rd group of indicators, which is less explored in the literature. And that is the state of the business cycle, where I'm going to use the level of the unemployment rate and the level of CPI inflation over the previous year. So that's my data. Those are my definitions of recessions. Of course, the first thing to note, right, is this is just a prediction exercise. I'm not going to be trying to identify things. And these predictors, of course, right, they're all highly cyclical. We're just talking about indicators that move over the business cycle. And so there is a high correlation across some of these indicators. So this table just shows you that for the period from 1965 to 2019, the correlation between the term spread, the corporate bond spread, leading indicators, or the change in the leading indicator, right, the momentum variable, the unemployment rate, inflation, or the change in the unemployment rate. So just looking at this first column, which is the correlation of the term spread with all of those, and it's weakly positively correlated with the corporate bond spread and with the leading indicator. It's actually very strongly negatively correlated, like that's the highest correlation in this table with inflation, right? So that might tell you something. Well, look, a lot of the literature has looked at the term spread as a recession predictor. Term spread is actually highly negatively correlated with inflation. So when the term spread is low, when the yield curve is inverted, inflation has tended to be very high, right? And that might tell us that actually something about the usefulness of the term spread as a recession predictor might be related to that economic fundamental, recessions. And similarly, the term spreads, positively correlated with the level of the unemployment rate. I think the main point is just, this is an empirical exercise. We're going to look at a lot of regressions, and a lot of the predictions from different models are going to be very similar because a lot of these variables are highly correlated. And so what we want to do is sort of understand the signals and try to understand the stories. There are going to be models that are a little bit better and a little bit worse, right? But when you are thinking about a lot of prediction regressions with a lot of highly correlated variables, you should expect a lot of models that fit pretty similarly. So what I'm going to try to do is look very comprehensively at the set of models and extract lessons, knowing full well that actually one should not expect any individual indicator to be the one if one's willing to look at a broad set of data, because data is really highly correlated over the business cycle. Okay, so what is the approach and what are the results I'm going to summarize? I'm just going to use a standard recession prediction approach. As I said before, I'm going to use predict at various horizons whether or not a recession occurs. Does a recession occur over the next 6 months, over the next year, over the next 2 years, or in the year beginning 1 year from now, right? So a whole sort of four quarter ahead recession prediction. And I'm going to look at 3 definitions of a recession: a large change in the unemployment rate, a large shortfall of GDP growth, or an MBR recession. And so as I described, I have 5 predictors and I have 3 recession definitions. Admittedly, the 3 recession definitions are quite similar, but they're not identical. And what I'm going to do is consider all 31 possible combinations of the 5 predictors for 3 recession definitions over the 4 horizons. So that's 372 equations. That's not that many. They're very similar, but I want to look at the common lessons from those 372 prediction equations. What are the important predictors of recessions, and how do those differ over different horizons? I'm interested in whether a recession is likely to occur over the next 6 months or 1 year. How is that different than I'm interested in whether or not a recession is going to happen over the next 2 years or in the year beginning 1 year from now? Okay. This is just very standard, a sort of limited dependent variable, a recession either occurs or not approach. This is obviously related to other work. So in my unemployment risk paper, I did some similar things. I actually did do sort of exactly this for large changes in the unemployment rate, but also looked at sort of, quantiles, different measures of the change in the unemployment rate rather than just the 0, 1, does a recession happen? Okay. So this graph summarizes for the NBER recession the fit of all 31 of those possible recession prediction models. So what I present in this graph is the relative Bayesian information criterion, right? So that's a measure of fit. I could have used pseudo R squared, but I used the Bayesian information criterion for a couple reasons. Right? One is, like the pseudo R squared, it provides a correction for overfitting to the data if you include many predictors. Right? Only predicting recessions, there's not that many recessions, and some of these equations have 5 variables in them. Right? You have a real concern that you might be overfitting the data. Secondarily, I find, but this might be that I'm an econometric geek, I find the Bayesian information criterion somewhat intuitive for comparing models because there is a large literature. This is sort of a classical regression, it's just a measure of fit, but in the Bayesian literature, right, there is a linkage between the Bayesian information criterion or the sorts criterion and the sort of relative likelihoods of different models from a Bayesian perspective, right? That by comparing the Bayesian information criterion of two models that's similar to comparing the marginal likelihood of two models. And one can get a sort of Bayesian view of whether or not a model fits better. And there's a nice sort of review, it's quite old now, for example, by Cass and Raftery, where they say, well, look, if the Bayesian information criterion differs by 3 or more log points, right? So this is in log. That's a pretty big difference in the BIC, and that should be viewed as evidence that the model truly does fit better. And if the difference is more than 5 points, that's strong evidence that the model fits better. So what I do here is I normalize by the worst fitting model. So that's shown all the way here in the lower right corner. The worst fitting model by the Bayesian information criterion is the one that uses only the unemployment rate and the bond spread. So according to the BIC, the worst fitting model, the one shown here on the lower right, uses at a 1-year horizon to predict the NBER recession, uses the unemployment rate and the bond spread. And then here's the difference in the BIC from that worst fitting model. As one can see, the best fitting model that uses T is the term spread. And so the best fitting model, and it is much better fitting than the worst fitting model, uses only the term spread at the 1-year horizon. This should not be a surprise. Like this, there are 114 papers arguing that the term spread is the best fitting model. And typically a lot of those are looking at the 1-year horizon. And so this is simply confirming what we already know from the existing literature, that all of my empirical results are completely consistent with a large body of literature. In fact, if one looks at the top 5 best fitting models, they all include the term spread. If one looks at the top 10 best fitting models, they all include the term spread. So the term spread at a 1-year horizon to predict an NBER recession, it's the best variable, right? There's a large literature. Now, what's interesting is that among the sort of well-fitting models, among the top 5 fitting models, the unemployment rate enters as often as the corporate bond spread, even though the unemployment rate is not often used as a recession predictor. The unemployment rate actually enters the best fitting model more often than the leading indicator, even though the unemployment rate is not often considered a leading indicator of recession. And CPI inflation enters as often as the leading indicator, even though it is not often considered a recession indicator. So those are hints that among good fitting models, some of these state of the business cycle variables like inflation and the unemployment rate, which are not frequently used in the recession prediction literature, are reasonable predictors. But again, that's just that they're in the mix. And to be perfectly clear, the term spread is the best predictor of a recession in the United States at a 1-year horizon. So let me then present summary results for a different horizon, and that is the horizon for 1 year, 1 year ahead. And again, these are in BIC points. So any difference of sort of 3 or 5 is a really big difference. So first, looking at the scale, even at a 1 year, 1 year ahead horizon, there are quite significant differences in the ability to predict recessions when one looks at these recession predictors. And in particular, we got 20 points here that these are sort of, quote unquote, statistically significant or sort of strong evidence in favor of different models. That's important, right? Because the existing literature, looking primarily at financial conditions or at leading indicators, says, well, you really can't predict recessions at more than a 12-month horizon. It's just a hopeless exercise. That traditional literature, and I think the best paper here, and I agree with all of the results in it, is the paper by Estrella and Mishkin in like 1999, where they looked at a lot of predictors, as I do. They looked at a lot of financial predictors and leading indicators. They did not consider the unemployment rate, and they did not consider inflation. But they looked at a lot of the sort of momentum or financial conditions variables, and they said, they didn't use the BIC, they used pseudo R-squareds. They're like, look, all of our pseudo R-squareds are negative at more than a 1 year horizon. And so none of these variables are very good. That's totally right. And in fact, if I look at variables that only look at financial conditions, I get quite poor fits, as is shown sort of in the lower left of this chart. But if one looks at the best fitting models for predicting a recession, at a 1 year ahead horizon, what one sees is that in the top 5 best fitting models, the unemployment rate and inflation always enter. So if one is interested in predicting a recession at a longer horizon, the unemployment rate and inflation are key predictors. And that the previous literature simply has not looked at those. Okay, so that's sort of a summary just for the NBER recession indicator, sort of looking across all of the possible indicators. And what one can see is that actually, like the term spread only model, which is sort of in the middle of this chart, fits quite poorly. Term spread and bond premium, sort of far to the right, doesn't fit very well. Term spread leading indicator and bond spread is the 3rd worst fitting model. So the traditional predictors at a 1 year ahead horizon predict very poorly. So that is, again, very consistent with the existing literature. This suggests that at a longer horizon, the existing literature has ignored the unemployment rate and inflation. So one can look, more fully at all the possible recession predictors, all of the horizons that I considered, and think about, okay, what do the data say about the indicators that help predict recessions at these various horizons? So this table summarizes the value of different predictors at different horizons across the 3 recession definitions. And what I report is the frequency with which an indicator is in one of the 5 best fitting models at that horizon across the 3 recession definitions. And so that means that a value of 15 in this table means that that indicator appears in every instance of the best fitting model at that horizon. Conversely, something 0 would mean that that's never among the best fitting models for that horizon. So if one looks at short horizons, like 2 quarters or 4 quarters, right, what one sees is that the leading indicator, right, and this should be the case because this is how they're constructed, is always among the best predictor at a 2 or 4 quarter horizon. The term spread is nearly always among the best predictor. It's near 15 at a 2 or 4 quarter horizon. And the corporate bond spread is more in the middle. And actually, the level of the unemployment rate or the level of inflation is not that useful at a 2 or 4 quarter horizon. Now, if we were to go back to the picture, right, this is not that surprising, right? The level of the unemployment rate, if it's getting low, right, there could be momentum. And so a low unemployment rate could just be followed by further declines in the unemployment rate in that AR2 dynamic, in the near term, right? So again, this is very much what was predicted by that simple model. If one then turns to longer horizons, so is a recession likely over the next 8 quarters or at the 1 year ahead, the 4 quarter ahead horizon, the results are very different, right? So the leading indicators do not often appear in the best fitting models, right? They're a measure of near-term recession risk. They're not a measure of medium to long-term recession risk. Similarly, the term spread is not especially helpful. It's somewhat helpful. And corporate bond spreads are not that helpful. What is helpful is the level of the unemployment rate. The level of the unemployment rate is in the best fitting model every time, 15 out of 15. And the level of inflation is among the best predictors almost all of the time. And so this says that at medium to long horizons, good recession predictors are different, right? It's the state of the business cycle, whether or not the unemployment rate is quite low or inflation is high. And it's not those traditional measures like the term spread or leading indicators. Okay. Just to sort of give a sense of the marginal effects here and how big these are, I want to show you, like at a 4 quarter horizon, the magnitude. So these are for a 1 standard deviation change. And what one can see is that in the sort of traditional model that only looks at, so that's the first row here, the term spread, the corporate bond spread, and the leading indicator, that a 1 standard deviation decline in the term spread, so the term spread being heading towards inversion, would increase by 0.12, right, or 12%, the probability of recession, right? So if the term spread is very low, like a 2 standard deviation low term spread, the probability of a recession is 24% higher than it otherwise would be. And similarly, if leading indicators are very weak, like an adverse leading indicator of 2 standard deviations, the probability of a recession is 16 percentage points higher. Right, so those are pretty good predictors. In contrast, again, these are all very highly correlated. If one looks at all 5 variables, and this is actually one of the best 5 models, according to the BIC, the effect of everything is a little bit lower, and that's just reflecting the fact that it's probably the case, as I talked about during those correlations, that some of the information, even at a 4-quarter horizon in the term spread, really reflects information about the state of the business cycle and inflation and unemployment. Right? The term spread is telling us something about recession, not necessarily because of the term spread being important, but because it also helps summarize the state of the business cycle. If one looks at the 4-quarter ahead horizon, right, what one sees is that, again, the term spread, it's less useful, right? So a 2 standard deviation, only increases the probability of the unemployment rate by 2 times 0.07, or by 14 percentage points, not by 24 percentage points. But more importantly, if one controls, as in this last column, for the level of inflation or unemployment, the term spread actually does not predict, that much. A recession, in fact, it has the opposite sign. Leading indicator actually has the opposite sign. And what one sees is that if the unemployment rate is 2 standard deviations below its mean, that increases the probability of recession by 30 percentage points. So that's a big marginal effect. Now, so just to summarize, and then to get back to sort of how does this tie in with business cycle dynamics, right? The term spread has a larger role in prediction. If one ignores measures like the state of the business cycle, ignores the unemployment rate or the leading indicator, and its predictive ability is very good at a 4-quarter horizon. Momentum, the leading indicator, is very important at short horizons. It's always among the best predictors, right? Positive momentum, very low probability of a recession. The economy looks good, so you're not going to get a recession in the next 6 months. And then the unemployment rate and inflation appear, in the US history from 1965 to 2019 to be quite important precursors of a recession. So let's just go back to the AR2 dynamics and simulate a model and say, can a typical business cycle model actually deliver logit regressions like the ones I just presented? So what I consider is a vector autoregression in the unemployment rate and the term spread. This shows you sort of the impulse response to the of the unemployment rate to the term spread or to its own sort of shock. Let's look at the response of the unemployment rate to the term spread, this upper left panel, over the first 20 quarters. What one sees is that if the term spread, and this is sort of a positive impulse, if the term spread becomes steep, times are good, the unemployment rate falls. And then what one sees is that the unemployment rate will subsequently rise. That's just the sort of dynamics that I showed before. So what I'm going to do is simply simulate a whole bunch of times from this vector autoregression. And then I'm going to extract three variables from this vector autoregression and put them in recession prediction models in order to see, does this reduced form model of a business cycle deliver logit regressions like what we just saw? So those 3 variables are going to be the term spread, momentum, or the change in the unemployment rate. And so that's going to be my leading indicator. So the unemployment rate falling, that's momentum. And then the level of the unemployment rate. Okay. So here's what the logit regressions look like across, a set of stochastic simulations from that vector autoregression, and then estimating a recession prediction model where a recession is defined as an increase in the unemployment rate by more than its 20th, by its 80th percentile, right? So a large increase in the unemployment rate. What one sees is that at a short horizon, the term spread is a really good predictor, right? And its marginal effect here of negative 0.1 is actually very close to its marginal effect in the sort of data of negative 0.12. Similarly, momentum, the change in the unemployment rate, is a really good predictor, strongly statistically significant. If there's a lot of momentum, you're not going to see a recession in the next 4 quarters. And the level of the unemployment rate is not useful at the 4-quarter horizon relative to those other variables. Again, those are exactly the results that showed up in the data. If one then instead looks at the 4-quarter ahead horizon, one does see that the term spread is marginally useful, but borderline significant. One sees that momentum is not useful at all, right? And one sees that the level of the unemployment rate is, in these bootstrap samples or these stochastic simulations, significant, and the coefficient is quite large, relative to it on the short horizon. So this, again, just a standard VAR, just a standard hump-shaped dynamics for the unemployment rate and the term spread predict exactly the type of results that we see in the data, right? The unemployment rate, the state of the business cycle, is good at longer term horizons, whereas the term spread and momentum are good at near-term horizons, right? So what this shows you is, gosh, actually, in a standard model, everything that I've talked about in terms of how to think about the data, how to think about near versus medium versus long-term predictors of recession, is just what one should expect from a very standard representation of the unemployment and term spread time series, that there's nothing surprising in these results. Of course, the results are completely new. Very little of the literature has looked at trying to predict, using the level of the unemployment rate or inflation, recessions at horizons of up to 2 years. But, the simple reduced form dynamics of the data suggests that you should use those things. And in fact, the empirical results are strongly supportive of that idea. And again, this is just the picture that I started with, right? That if the unemployment rate falls, you're going to expect it to go back up. And so at medium-term horizons, this red line, this sort of red arrow, you should expect a low level of the unemployment rate to predict a recession, whereas other variables are more useful in the short run. Okay, so that's basically all that I have this morning. So to summarize, I've looked back at the literature and pulling it all together, signals from financial markets, leading indicators of activity, and gauges of the state of the business cycle are all useful for recession prediction. One thing that really comes out, the term spread is a really good predictor. Macroeconomic data is really highly correlated, and approaches that emphasize only the yield curve seem likely to overstate the recession signal from that variable because they're just not considering other factors. And that a lot of times that doesn't matter because factors are highly correlated. There are times when the factors are moving in really different directions and it does matter. And so, for example, in 2022, the state of the yield curve and other variables were really out of whack with their historical patterns. And so it really did matter if one was looking at the yield curve versus other variables. So, for example, in the middle of 2022, the level of the unemployment rate and the level of inflation indicated you really should expect a recession, over the next 2 years, whereas the term spread was not suggesting that. Okay. The results, demonstrate to me that some indicators provide valuable signals at short horizons, such as leading indicators, and that some indicators provide valuable signals at medium-term horizons, like the unemployment rate. And again, as I just mentioned, all of these results are what we should expect if we just think about the business cycle, right? Things go up and down, and predictors should be useful at different horizons. So that is all that I have today. I will stop there.